about the panel and hearing about middle markets. So with that, maybe you want to introduce yourself?
All right. Michael Ramin from Sharestates, Director of Sales. Sharestates is a direct private lending platform. We are based in New York. We are national. We do 1 to 4 family fix and flip, mixed use, multifamily, ground up, and the rental loans on 1 to 4 family portfolios, multifamily, and mixed use, hopefully by the end of this month.
Okay, great. This panel was getting warmed up pretty early. I think we're all ready for a happy hour in our near future. We're sharing some pretty good stories earlier. But we did a deal a few years ago in Vegas and got engaged by a large multifamily developer in Southern California. They did LP equity for a large project here in Vegas, and we were calling a bunch of guys. And one large LP group said, Vegas is too small a market. We won't do a deal there unless there's an NFL team. This is about 7 years ago. And they got an NFL team. I'm not sure about after yesterday if they've got an NFL quarterback, but that's a whole nother situation. My first question to you guys is, what defines a small and middle market? Because I think that is different for each of you.
Well, we're based out of New York, so I feel like everything outside of that's a smaller market.
There's the New York right there.
But I think through COVID, you did see people were open to different markets. We've seen people like upstate New York where wasn't as big, or there was distressed housing or homes, and we've seen borrowers go in there and buy like 100 properties, 400 units, turn it over, and a lot of people would think that you wouldn't take it over, but with people working remote, any market really works. I think the secondary markets where there may be 5 to 10 miles outside of a bigger city, I think we've seen a lot of action on stuff like that. You see that a lot in the Carolinas. So if you're in a bigger market in Carolinas, like 5 miles away, you see something a little smaller, but you'll see big box stores opening up in there. So you'll see like the Walmarts, the Targets, and everything in that secondary market now, where normally you maybe saw it in the bigger city or the bigger suburb.
Got it. Okay, great. As private lenders, when do borrowers generally choose you over a bank?
There's several reasons. Concentration limits.
Okay.
A lot of the build-to-rent guys will have 100, 200, 300 homes.
Right.
It might not fit the typical bank. The bank might cut you off at a certain million number or a certain amount of units. So that's a lot of times they'll come to private lenders. We don't have a concentration limit for borrowers. Our largest borrower's done over 5,000 units, so they've been comfortable with that. I think the other times they'll come to a private lender more is for leverage or lower docs. I think post-pandemic, right now where people call it like a credit crunch, or you see less liquidity in the market, you saw on rental loans, you've seen cash outs as high as like 80%. You've seen that go down 5 to 10% leverage-wise. You might see with regular community banks or other banks that people are going to, you might see that in the 65 range on a cash out. I think it helps on that end. Also with the construction, so the build portion of it, most banks, speaking to people that come to our booth outside, most conventional banks were like 65 to 70 loan to cost for a lower rate. It's easier not to raise the equity and be able to get the higher leverage, so get up that 85 to 90% loan to cost on a ground up construction loan.
Sure.
So it's raising less equity for the project. Typically on the future value, you know that rental loan is going to be able to take you out based on usually middle and smaller markets, lower taxes. So the DSCR works a lot better.
So are you using the takeout loan of Fannie or Freddie or some other source as a sale? Ben's shaking his head no. Is it a credit enhancement, or are you underwriting that at all?
So we're underwriting everything in-house. We're not using anything based on like a Freddie or Fannie takeout.
Okay.
And they have made adjustments on underwriting though. So when the rates were, I would say like January, you're looking at like 3.5 to 4.5% range in the DSCR market.
The glory days.
The glory days.
Yeah, those
3.75
were really good times.
Those are good times. But even then, if you were doing an interest-only loan, it would be underwritten off of interest, taxes, insurance, not even the principal.
Yep.
Right now, even on an interest-only loan, they're looking at the amortizations based on the whole 30-year, just to make sure they're covered if there's a takeout in 5+ years.
Got it.
Relationship with a private lender is huge. Most private lenders are not loan-to-own shops anymore. It's a relationship bank that wants to see volume business from someone that has a history of paying off loans. And they're able to come back and recycle that money with that lender. So I think the relationship aspect, like most banks, we're saying if we have the discretion on the default fees, on the draw process, so you can get draws a lot quicker, a lot of stuff works out a little differently.
Okay. Local lenders definitely know their market. We shopped a deal in Bozeman, Montana, and no bank could do over 10 million. This one needed 15. We were shopping the loan to multiple banks, and I called one, and he said, I'm interested, but I need to do some work, find a syndicate bank. Went to the next bank, and he said, just get back to me. I'm having beers with the guy that I called first. And they came back to it 3 days later, and it's self-syndicated the loan. I mean, it was crazy. And at the same time, banks are, especially on the national level, pulling back. So the things that we were getting 65, 70% leverage from banks at one point, now we're talking about 60, 55%, which is a really unique opportunity for you guys. Are you seeing more volume now come through as a result of that?
I think we're seeing more volume from several aspects of it. A lot of capital providers in our industry pulled out. So they either went on pause, so it kind of shrunk a market where it was very liquid, 6, 7 months ago. Leverage definitely helps.
Yep.
We have several borrowers that we've had for over 10 years now with us that going up to that 75% on the cash out or 70 helps them out a lot, on a 30-year especially. Even with the higher rate, a lot of people are rate sensitive. The rate shouldn't matter. If your DSCR is hitting and your cash flow that you're expected to make is there, then the loan makes sense if your property's cash flowing. So everyone's going to be rate sensitive. No one wants to pay 10, 12, 14%. But if you have a rental loan at 7%, even principal and interest on a 30-year AM, and you're still hitting a 1.4 DSCR, should you take the loan or not? If you can cash that money out and buy another property, which is going to bring more income, might make sense at the higher leverages. It has definitely increased volume. Seen a big lift on that. We've also seen it on multifamily. It's a little bit out of the build to rent space, but it's in the rehab to rent space. There's a lot of distressed, poorly managed, or old managed multifamily properties in the country, and you're seeing a big pickup on those right now. A lot of people are buying them. The rents are under market. They're not in the right condition. They don't have the amenities they should have, and the people have changed the way they've done management. So you've seen a big upgrade there.
Okay. So I tell my guys all the time, trust is the coin of the realm. You've got to have trust. You got to be able to look at the other person and tell them, hey, I'm going to deliver on this, and go to your relationships and bring those relationships to bear so that they get their project developed. And that's a two-way street. When you guys were talking earlier about new relationships and people that you're seeing, because there's a lot of banks out there that are pulling back and now you guys are getting more deal flow. For this audience, what are you looking for in that new relationship? What are you looking from your side? Guy comes in for the first time and says, I need a loan. What are the boxes that you're checking that are outside the underwriting, outside of the DCR test or whatever LTC they're using? What are the things that you're specifically looking for?
I think track record is the most important. A couple things you're going to look at outside of leverage and even appraisal coming back. If a borrower's done 5,000 properties, typically sometimes you could lend to that person blind and be like, hey, they're probably going to be a good borrower if they have that. We like to look at past projects. So outside of verifying the track record, we want to see what they purchased the property for, what their rehab budget was, if we haven't done loans with them in the past, and what their future value or anticipated value is. So see in the market what spreads they've been working with and working with. For repeat borrowers, that becomes a little easier because we've already seen their whole draw process and everything.
Sure.
I think track record is definitely one of the most important things. One of the things we'll look at is liquidity. So I think very big in this industry is people syndicating, raising money outside of it, but we want to make sure your sponsor is liquid themselves. Outside of having the experience and being able to raise money, it's nice to have capital and equity in there.
We're seeing some real time, our clients are saying, look, it used to be LIBOR 275, LIBOR was 30 basis points. Now it's SOFR 350, which is like 5.5. I can't take that loan. You're like, well, look at it this way. If you get a loan now, you can build through this next cycle. And there's probably a lot of tailgate meetings where you're renegotiating subcontracts on the spot, saving money in the process. It kind of doesn't matter what your cost of capital is because you're building.
So for ground up, they'll go up to 85% loan to cost. It really depends on approval. So anywhere from 50 to 75% of the land, and then up to 100% of the hard cost. Fix and flip, same model, but you're going to get a lot more money up front because you have a structure in place. They like to do it based on like the future value of the property. Recourse, same thing as Rob was saying. It really just depends on the project and what it is. Regular fix and flips, you'll probably still see full recourse, smaller ground up. As you get into larger construction projects, you'll see burnouts, bad boy carve outs, anything like that.
Great.